what exit strategies are there for your investors when they invest in these OZ projects? So kind of shifting here from social impact into the deal, right? And so I'd like to hear if any of you have any thoughts to answer Melvin's question here. Sanjay, you have any thoughts on that, like exit strategies for investors for your deals?
Sure. No, absolutely. No, being a PE firm, it's very important for us to paint the entire picture. And the OZ is a different deal in the sense it's a 10-year hold period, but we can do many things within the 10-year as long as we don't give the capital back to generate that alpha. So of course, as much as, let's be very honest about it, there's threefold impacts here, right? One is the social impact, there's the financial returns, and then three, should you choose to, you can also create greater good. For example, we're talking with the cities, the mayors, and they're giving us stat dollars, additional benefits, and all these things too, right? Where we can. And when you put these three things together, it just maximizes the return. But in the end, investors are always going to go, what am I going to make at the end of 10 years? And then you add their tax benefits, you show them the picture, it just changes the game, right? So investing, as you all know, is for the long run. And again, the way we look at deals is it has to be a good investment deal, right? And then the OZ is an icing on the cake, like on top of it. It's not the other way around. There's many things we can do to do social impact, to give away money, work with nonprofits, and do all these things should we choose to. But here it's a twofold impact. So for us, it's really a thesis about the fund and what we are trying to create within the fund in terms of the alpha, right? So we have a standard model on what we do. So we kind of go with that along with our other funds. But by far, this is doing exactly like our other funds. But then you add the OZ benefits of tax is just out of the park. But not always you get everybody to believe in the 10-year because it is a longer hold period. They're like, hey, are you even going to be around in 10 years? So you only, it's a different kind of a conversation you engage with. We only open this up to some of our top tier investors. And we are also very selective with who we work with because it's a 10-year period. And I want to make sure that we are having the right investors too.
Absolutely. Yeah, that's great. I want to hit everybody actually with the same question. So Ted, various exit strategies for your investors.
Yep. So ours is unique, and we're probably one of the only that you'll hear out there that are attempting to pursue Avenue 1, which is called an UPREIT transaction. In an UPREIT, you essentially do a full portfolio sale in around the 2029, 2030. And what that will do is it'll create a unit price for all of our investors where they can sell out either all or a portion of their gains in the future. We aim to do that because many of our investors are long-term, where they're saying they don't need the money in 10 years. They'd like to kind of continue it to grow because you actually have until 2047 to allow your money to compound and grow. So it's kind of even crazy to think what it might look like an investment today, if held for 26 years, could potentially turn into. And all along the way, they're going to have the option to that all that money's growing tax-free. It's not like you have to liquidate in the 10 years. So that's our desired route is to do the UPREIT transaction. If not UPREIT route, we'll just do we'll go through asset by asset and begin to sell them off based on demand of our investors to be liquidated. Our fund is multiple assets, so we don't necessarily have just one that we're putting, one asset. We have multiple, so we could, think of like 2020 wasn't a good year to sell a hotel. So if a COVID 30 hit in 2030, we probably wouldn't look to sell the hotel at that point. We'd probably want to wait a few years to sell a more favorable asset. So having diversity in both location as well as asset type, we feel puts us in a good position to make the best decision for the real estate, not because we need to get everyone's money back in 2031, like we said they would, because they all wanted it back in 10 years. We've given ourselves some options there.
Yeah, interesting. This is the first time in years being around this that I thought of diversity in two different ways, right? Like there's the incentive is based around the social impact, and there's diversity and inclusion in that. And then you're also talking about financial diversity, right? And you're talking about that with your funds. It's not the first time I thought about it, but it's nice to hear like the two sides. Lawrence, exit strategies for you guys?
Yeah, it's along the lines of what Sanjay and Ted said, it's you have to be flexible, right? And everybody's in it for a different period of time. We get a big question of, it's 10 years, it's so long, it's, what are we going to do? Somebody says, I'm 75 years old. Why do I want to wait 10 years, right? And but there's ways to get your investors a good portion of their money back in between there, in terms of their initial capital, But one thing that we talk to people about is, this is, if it's long term like this, if you can put this in here for 26 years, it's a great way to do estate planning. You're talking about long-term investments and estate planning. It's possibly a great tool along those lines, and that's another avenue to talk to that we talk to our investors about. If they're concerned about the length of time and when they're going to get their capital back, and you also give them the option to keep it in for, like Ted said, 26 years. You get the option to get capital back within 5 years through the way to refinance some of these projects and pull some capital out. Keep the initial investment stays. For the 10 years, 10 years, 1 day. Some of those investors want that. They're going to want that money. Yeah, and you just create those avenues for them to get it.
Yeah, it's like anything. It's not for everyone, right?
Right. Right.
But
Chris, I just wanted to add something. I was talking to somebody and then I was just telling them, we invest our own capital into our own OZ. I keep telling, as an entrepreneur, that's my 401k for 10 years, right? That's a way to put instead of doing a solo 401 or anything like that, just putting our own into our own dog food that we generate in real estate. So
absolutely, yeah, it's a great point. And these same concepts, everything you guys are saying applies to the operating businesses within opportunity zones as well. Same themes, same types of conversations. When we did our dialogue with Hall Labs, with Verti OZ, it's like, talk about diversity, talk about exit strategies. It's all very, very similar. Chris, do you have any other insights to add on top of what these guys just said about exit strategies?
Yeah, I mean, it's pretty straightforward for us, I think, as a multi-asset fund, as Ted said, right? We have the opportunity to sell off assets individually. We build our pro forma around the idea that we'll sell off the assets individually. You don't want to be forced to sell at a specific time. If COVID-30 does hit, we use a similar line as we're talking to people about it. So we tell everybody up front, think of this as an illiquid 10-year asset, 10 plus year assets, just so we're setting the framing on that. In our case, we're building cash flowing assets. So we don't expect to distribute any cash the first 2 years. We're using this money to go develop these assets. But once they are stabilized, we expect to be distributing essentially 100% of the cash flow back out to the investors along the way. So there is cash that's coming back. Obviously, we keep money back for working capital reserves, but we'll be distributing that cash flow from year 3, year 4 forward. There are some opportunities to refinance. As Lawrence mentioned, some of our properties, we're obtaining HUD financing. That financing is so attractive, we won't refinance that. So it's not a very black and white answer. As far as the sales go, we build a pro forma on the idea that we'll sell these assets off individually. Though in the housing market particularly, I think there's the potential for the premium of selling a whole batch of housing projects together. We've got multiple 100-unit deals. There's certainly buyers for those. Sometimes there's buyers that would like to buy the entire portfolio. Similar on the outdoor hospitality side for us. There are some people doing some other more complicated things. There's enough complication around explaining opportunity zones to people, though, that we've tried to keep it very simple. We want to hold this for at least 10 years from the last dollar into the fund. So if we're fundraising, it's going to be a little longer than that 10 years. And then just the reminder for people that when you do get past that 10 years, it's not just that you get to avoid capital gains, you also get to avoid depreciation recapture. So if we had a smaller base, we might try to hold on to them for longer, but we do intend to, as soon as possible after the 10 years, go ahead and begin exiting from these assets, as long as we're at the right part in the market. If it's a major downturn, it's nice to have a cash flowing asset that you're not forced to sell. Nobody's forced to sell these immediately upon 10 years.
Yeah, there's one thing that you mentioned, Chris, that we talked about on our preliminary call, and that was the HUD loan. I made a specific note of that, and it was about, you were saying that there's a delay in some of those processes, and in this case, it may even be worth it a little bit because of some constraints. And And you said something, and again, I don't mean to put words in everybody's mouth, but you said like, we could be wrong on this. And so I just really appreciate the openness of like, hey, we'd like to have a crystal ball, but can you talk about some of the fundamentals of like packaging these deals and maybe even look into your crystal ball, talk about some of the challenges that are happening right now?
Yeah, I mean, I'm glad you brought up challenges, because there's real challenges around this, right? You look at a lot of developers and they're doing development, merchant development. We're going to build this and sell it in 3 years and target this high IRR. All of us that are talking here are talking about long-term patient capital. One of the questions that first comes up is, hey, what cap rate are your commercial assets are sold on a cap rate, right? It's basically a multiple of your net operating income. What cap rate are you using now, and what are you predicting for 10 years? Like, rub that crystal ball. Is there going to be cap rate compression or expansion, and how do you forecast that? So for us, it starts with the fundamentals of the asset. Make sure you're investing into an asset that you want to own for 10 years. So it starts with those fundamentals. A big piece of that right now is this financing component. You're talking about owning an asset for a long term, so your financing is also going to be long term. It really matters around these deals. A lot of developers had the HUD rep that we actually work with. I think the quote from this week is, getting a HUD loan is like hugging a porcupine, I think is what he said. The closer you get to it, the more it hurts, right? The closer you actually, it can take a year to do this. And that was a quote from the guy at HUD, right?
I'm stealing that, by the way.
Yeah, so we're actually closing. We just got approval on our first HUD loan. One of the nice things about a HUD loan is it locks in your interest rate from we're doing a 221D program. That means they're giving us a loan that's going to go from construction all the way through stabilization. It's got up to 80% loan to value. It's got a 40-year amortization. So for us, we really look at the idea over 10 years, there's going to be this cyclical nature to real estate. When in 10 years, nobody knows. Might there not even be a cyclical? Sure, but it's rare that there's not one, right? And so for us, we really look at having a very safe, conservative debt service coverage ratio, making sure that even if there's vacancies, even if there's something wrong, we can always pay the debt. Rule number one, don't lose anybody's money, right? And so the HUD loan, though it's a long-term thing, if you're doing a shorter project, that length can really mess up your project. It's been very valuable to us to pursue some of these deals and obtain that type of financing. Kind of a separate question, but it's very important for us as fund managers to obtain non-recourse financing so that our investors can get basis and take depreciation for those of them that are able to use it. Because when you invest into an OZ fund, your basis is set, your internal basis is set to zero within that fund. So we are very focused on obtaining non-recourse debt on all of our deals. It's a very hard thing to do on smaller projects. Some of our smaller projects are the high impact projects. So it's one of our challenges, but particularly around housing, there's a lot of different agency lenders out there that have really, really amazing terms right now. That 40-year amortization can turn a good deal or turn an okay deal into a very good deal if you're able to get the right type of lending on it. We're fortunate to be in a state that has a really strong net in-migration of people. It's exacerbating our housing shortage, but we have a lot of confidence about the fact that the demand will be there for these. If we build it, it's not if we build it, they will come. They're already here, desperate for housing. So we just need to build it and make it available, right? So we don't have a lot of vacancy risk around it, but construction costs are so high right now. Anything that we can do to make it a better deal, rents, you don't want to push up the rents. Construction costs have been pushed up. The biggest lever that sometimes you can pull is just getting that financing in place.
Do any of you have anything to add to that? There are certainly challenges right now, and I think it's totally worth talking about.
Supplies costs right now are high, so we're having a hard time determining on a couple deals whether it's time to break ground and move forward with the plans, because you can't tell. And Chris and Lawrence and Sanjay, I'd be curious to hear your thoughts. If we're at a point where is the bubble about to pop, or is the bubble going to get bigger? Is the pricing better now? Do you want to lock in on a project now, or are you smarter to wait a little while till it goes back down and recedes a little bit? So there is some challenges there that I know we're trying to figure out.
So you're saying that Sanjay, Chris, and Lawrence have the crystal ball combined.
I like hearing what other smart people have to say so that I can go and repeat it to other people, like this porcupine comment. I'm totally stealing that because we have a couple of them. So
yeah,
thanks,
I
Chris.
love that one. That porcupine comment was perfect.
But to add to To add to what Ted just said, I mean, we literally had that conversation yesterday. We've just locked in one of our housing projects a month ago, full GMP contract. We've locked in the pricing. That supply risk is now, off onto the GC, right? We've got another one where we actually think there's some value in waiting. So if we're on that scale, we've seen some of the pricing has come down just in the last 3 weeks. I mean, it went up, lumber went up by a factor of 4, and now it's come down like 6%, right? I mean, it hasn't come down much, but I don't think as far as our crystal ball goes, we're taking the bet that some of the supplies, I don't think it will come back to where it was by any means, but some of this is we believe that some of this is a one-time supply chain constraint, and that there will be some sort of kind of secular returning to normal pricing, and that the prices are actually going to go down. So that delay that we experience in HUD, for instance, you can't lock in your pricing. You can't at least sign the contract. There's ways to mitigate it, but you don't lock in your pricing till you get the loan. There's actually normally that's a real penalty for you because prices are going to go up. We actually think in this case, there's some potential value in waiting to lock some of that in. And we're using that waiting time to obtain the better financing. So it goes both ways, but in our case, it's a portfolio. So we're doing both sides of that. We are locking in and we are waiting both, but we are betting on the fact that some of the supply cost will come back down.
Yeah, I agree with you, Chris. That's exactly what I was going to say. We're in that position too, and Ted, same thing. Where it's like, do you start it today? Do you wait? In 6 months, and you listen to the Fed and what they're talking about with this inflation being, very temporary. And by the end of the year, like Chris said, it could come down, these supply constraints, as more of these chains open up and things start flowing again. It's supply and demand. It's very simple, and we're doing the same thing. We're taking this time to kind of really make sure that we're getting the right equity and debt lined up, and when we model for these projects, we look at them as, I always say, we got a model to weather the storm. The storm could be, COVID. The storm could be, a spike in rates. The storm could be, supply
black swan
constraints.
event. You call it a black swan event. That's a caliber
Yeah.
one that we've used, because we had our, beginning of the year last year, this, annual update of what it's going to look like. What are some of the threats? And one of the things they put could be a black swan event. We don't know what it is.
Yeah.
But
I mean, we
all
can't
agree
model for everything.
The last 15 months have been a little weird.
Yeah, exactly. And we learned so much. We learned so much from 2008, and everything that happened there. And people thought I remember in 2005 just going, how much longer can this last? And all of a sudden, boom, and when everybody thought it was like, the train was going to run down the track forever, it came to an abrupt halt. And so, for those of us who've been in it for a long time, we've seen this. So we try to model for some of these things as best we can. So my crystal ball is kind of like what Chris is.
Well, I think that may be like a visual that we need to start using, is like the crystal ball for this whole period.
Yeah, Chris, let me comment to one yours, and then I'll answer Ted's question too, because I have a different viewpoint there. So Chris, to your question about the challenges in the OZ, our biggest challenge being a small to medium firm is just the regulations, the rules, the paperwork, and all the 9 yards of making sure everything's kept in compliance and all that, right? There's a lot of rules around it. So for a lot of people listening, just make sure you know what you're getting into, and make sure you have good paperwork and good all those things. So that is a challenge we see as utmost. That's why we may not give as much focus to the OZ at times, because of just the amount of regulation that is involved in it, one. And then to answer Ted's question, I have a different viewpoint, and please don't, this is just my personal opinion. I think the pricing and all this is here to stay. It's only going to go up. The way to look at it differently is we are going through the supply chain from a different aspect. We are like trying to be vertically integrated, go acquire a construction company, go acquire a HVAC company, trying to go figure out scale in the margins there where we can add. And on the other end with COVID, there's many shifts happening in the world right now, right? The systematic shift in how people are working, how companies don't have to put money into offices, class A office buildings, go into co-working spaces, do plug and plays. So that is a huge cost saving there, right? So I think how we are doing business will change, how we are operating will change. And if we are at the forefront of some of these changes and we can take into account those changes and shift some of the dollars from here over to, let's say, lumber, and then put those into other places, I think it will even out, right? Because these shifts are happening in front of us. Call it crypto, call it blockchain, call it work from anywhere, call it remote working, people moving from San Fran, selling their homes, buying all cash, a big mansion down in Atlanta, or all these happening. So I think we have to look at the larger perspectives happening. I understand lumber is one part of it, other supplies are a part of it, but I think nobody would be that easily spawned to putting their costs down. They will figure out a way to keep it at that or more with inflation going up. That's my viewpoint. So we're going with that thesis, and if it goes down, hey, well and good, I'll take those savings.
Yeah.
Sanjay, thank you for that. I mean, that's the point of these conversations, right? Is not just to say like, here's the project, everything's fine and it's, and we're not saying that like, oh, everyone like run for the hills. It's just, hey, we're all in this together. How can we dance with a new way of doing business, of working in physical spaces? Right? I mean, commercial real estate is walls and floors, right? Yeah.
Yeah, and then just look at this panel, right? Had COVID, again, this is my viewpoint. I good kudos to Chris, putting this together, putting all of us here, having the conversation. Let's say before COVID or 2 years ago, probably this could be an event. We could all be flying in, spending all the money, doing all the things. But here we are, accessing everybody from wherever we can. And this could be global. This could be, just in the States or wherever we are thinking. So I think those systematic shifts are happening, and we got to be aware of all these.
Well, you do know we're all flying to Puerto Rico in a couple of weeks, right? Like that just happened. And so, but it's not like it was, that's for sure.